Hi, welcome to another episode of the Trading Rooms podcast. As always, I'm your host, Raghu Kumar from Rain Platforms. Today we talk about a topic that is very close to me. I'm going to start with a very small story. When I first started trading in a quantifiable manner, using quant systems that I had built, I actually came across some systems which had a positive expectancy and essentially had a winning edge. But when I started trading them live, I knew nothing about risk management. And long story short, it wasn't long before I blew up my account. Now, luckily for me, I was trading with a very small amount of capital, but the lesson kind of hit home very quickly. And I remember spending many months just reading up about the very basics of risk management and how a lot of things when it comes to risk management are slightly counterintuitive. I am a very kind of all or nothing person. When I believe in something, I tend to go all out, whether it's in life or in trading. And so when I think about having a trading system, I think about developing a system with an edge. And then once I discover my edge, to really go all out with those trades. But it took me some time to understand that risk management doesn't work like that. In fact, it's all about controlling your losses and, more importantly, being able to endure different very bad situations when you go through a drawdown and things like that. So being able to endure a drawdown so that you can actually give yourself an opportunity to make money in the long run. At the same time, to not be too conservative to the point where even if you are doing well, you're not really moving the needle very much. So finding that sweet spot and finding a way to scale over time as your capital grows. These are all things that I learned the hard way. I didn't know Sourabh Sisodiya back then, which brings me to the interview topic. The topic is, of course, risk management and controlling risk. And today's guest is none other than Sourabh Sisodiya. Sourabh is one of the leading practitioners in India when it comes to building quantitative systems and sharing his knowledge with the retail public. He's got a very active Twitter following. And what I really appreciate about Sourabh is he doesn't just talk the talk, he also walks the walk. Again, he is from Quantify Capital, and Quantify Capital basically builds, quantitative investment and trading models to generate stable and consistent alpha. Sourabh is also the founder he is a chartered financial analyst, a CFA. And of course, in India, the CFA charter is one of the most respected designations in finance and is widely considered to be like the gold standard in the field of investment analysis. He's also NSE certified as a market professional, and he's also SEBI registered as well. Other than trading on his own, he trains and consults large proprietary trading desks, many of which have, hundreds of crores in capital, and hedge funds on algorithmic trading and how to build quantitative systems. He regularly provides and gives trading workshops at the top universities and colleges in India, including IIT Bombay, IIT Delhi, IIT Bangalore, and so on. I strongly urge you to follow Sourabh on Twitter, where he constantly posts, not just things related to his trading, but also very motivational content, which I feel like, hits home for him, and that's why he's sharing it. So again, what I appreciate about Sourabh is he walks the walk and talks the talk, and that's pretty rare in this field. And we're going to be talking about risk management. So I hope you're able to walk away from the interview having learned just maybe even a thing or two as it pertains to dealing with risk, dealing with drawdowns, especially when it comes to the psychological turmoil that can be placed on you when you are going through a drawdown. Before we get into the interview, I'm going to spend just a couple of minutes talking to you about our sponsor. This episode is brought to you by and sponsored by TradingRooms, India's first automated social investing and trading platform. TradingRooms' goal is to introduce automated trading to the masses, because when you subscribe to a room on TradingRooms, the trades are automatically taken on your map brokerage account, and the platform is integrated with more than 15 brokers now. To learn more about TradingRooms, check out www.tradingrooms.in, and the link will be provided in the description below. Without further ado, here is my interview with Sourabh Sisodiya from Quantify Capital. So, hey, Sourabh, welcome to the podcast. Sourabh, I thought we could start with just your general background to trading. How did you get into trading? And also, if you can also talk to me about how you got into systematic trading, that'd be great.
So basically it happened with one of my dad's friend. He had come to office and he was talking about how you made money by buying and selling, and he was talking about options. I did not understand anything at that point of time, but that intrigued me, that how can one make money by trading? Like, how can one buy and sell intraday and make money? And that's when I got interested into trading. I started to read about what the stock markets, how this thing works. Then I came to know about Warren Buffett. But I realized that fundamentals is not for me. So I tried to buy stocks for the long term, but I realized that this is not my cup of tea. And I come from a computer science background. So I realized that if I want to be successful in this market, I need to find a method for this madness. So that's when I become more systematic. I started to learn about options. And then I realized options give me the edge to trade in the market. And even if my view goes wrong, I'm able to manage my risk. So I can control my risk. And even if the view goes right, I'm able to maximize the profits also. So I think after that, I have been talking and reading more about options only. And that's how I got into systematic trading. And I have thankfully I have a good tech team who helps me backtest whatever data I have. So that's where I realized, and I did work with few of the people who are doing good in the quant industry. And from them, I realized that if you want to be successful, if you want to scale up, you cannot randomly look at charts and buy here and there. You need to have a system. That's what is scalable. If you want to scale up, you need to be systematic.
Sure. So one question that comes up over there is, for a lot of traders, the options segment can be very complicated, can be, intimidating. And yet with you kind of jumped right into it, right? Just kind of curious to know, how did that happen? Why, or how did you have the conviction to dive into options when, most traders, I think, start out with equities and they kind of slowly plunge into options trading? And also for retail traders out there who are listening to this, what do you suggest for them to start trading initially?
Okay, so basically I also started with equity long-term investments. But what was happening is when the market went down, whatever gains I had made had gone away. So then I started with fundamentals, then read about technicals. But I still realized that technicals is not giving the kind of stability I want. Sometimes I used to make money, sometimes I used to lose money. So I wanted to also cap my risk overnight. So I was looking for options or looking for ways in which can be done. And then I came to know that there's something called as options. So that's where I started to read more about options. And for a retailer, I would say The Bible of Option Strategies by Guy Cohen is a good book. So it could be a good starter. So that's when I realized that you can make money by time also. And I was completely fascinated that how can you make money even if the stock stays at the same price. So that's where I started to read more and more about options, how the Greek works, how you can manage your risk. Options, yes, they are leverage instruments. The risk is high. But one thing is that if you trade options properly with a proper system and you manage your risk, definitely you can make money. So in last many years, I've seen many black swans, many circuits, very big moves against my positions. But due to controlled risk management, I think the damage was minimal. So that's when I came to realize that options is something that every person who is even not trading options, but to have some basic understanding so that they can minimize the risk or even minimize the risk of the equity portfolio in bad times.
Sure. And I'm sure we're going to talk about risk management today a lot because that seems to be one of the things that you talk about a lot on your Twitter. Before getting to that, I did want to spend a little bit of time talking about your general trading strategies, right? And And again, with your Twitter, you do spend a lot of time talking about trading strategies as well. Can you generally discuss the types of strategies that you use and also the rationale for using them?
Okay, so the major part of my trading book is basically non-directional strategy. So what is non-directional strategy is basically you're not taking any direction on the market and you are trying to capture time. So basically options have something called as time value in it. And in India, basically for the index options, we have weekly options. So as time passes by, that options lose the premium value. So to maximize, to benefit from that, you can sell those options. So my thought process was that, okay, I looked at the theta decay curve. So if you look at the theta decay curve, you will see that as time passes by, options lose value, which means if I sell those options and if the market stays at the same place, I can make money. But it's not so easy, right? Because markets do move also. So that's when I realized that, okay, if I'm selling options, how do I manage my risk? So basically, that's what my core style is, selling options. And I manage my risk by putting stops on the OTM leg. So basically from a trade, which is a strangle, I convert into Iron Condor if the trade is against me. And then I manage that trade and try to capture the time decay. So this is the major strategy which I deploy. And the rationale behind it is, selling options is quite scalable. So if you want to deploy even like 100 crores, 50 crores, you can easily deploy that into option selling strategy. And one thing is certain, that time decay is certain. No matter whatever happens, like the decay is certain. So if you're trading a trend following strategy, there are prolonged phases of drawdown when the market is not in your favor. But in an option selling strategy, basically a non-directional strategy, one thing is certain, that if you manage your risk and the market stays within your range, you will make money. And even if it doesn't, the loss can be minimized if you properly adjust your trade. So the major part of my trading book is basically non-directional strategies and how to manage the risk and how to capture time decay, because this is something which is universal and scalable. And some part of my book I deploy in trend following strategies. The only rationale behind deploying some money in trend following strategies is, as I say, market is 20% directional, 80% sideways. So 80% of the time, the non-directional strategies are making money. But in non-directional strategies, the gains are limited. Like you cannot make unlimited money. But in directional strategies, when the market is in a big directional move, you can capitalize on that and make directional money. So even if you're right 30-40% of the time, then also you can make big money in directional. So overall, I think using both strategies, my drawdown is limited because in a trending phase, the directional strategies give money. In a sideways phase, the non-directional gives money. But the major allocation is towards non-directional.
Got it. Couple questions that come up over there. Could you actually walk me through like an example trade, right, in terms of how you would initiate an option selling strategy and then convert that strangle into an Iron Condor?
Definitely. So can I share my screen for that?
Yes, you can.
Yeah. So is my screen visible?
Yes.
Okay, so I'll take an example of BankNifty. So BankNifty, the current price is 34,482. So what I do is, so suppose we are trading the monthly options. So what I'll do is, basically I'll sell a put which I think is a good support zone. So currently market is respecting the 34,000 level. So I'll sell 33,000 put, which is 1,000 points away from that. And on the upside, market is facing resistance around the 35,000 level. So I'll sell a call which is further than that, which is the 36,000 call. So if you see, this is my current trade, okay, which I have created. Sell 33 put and sell 36 call. You can see the break even on the downside is 32,566. On the upside is 36,434, which means even from the current level, Bank Nifty falls 2,000 points. I still won't lose any money. And even if the market goes up 2,000 points, I won't lose any money. But one thing you see here is the max loss is undefined, which means suppose tomorrow there's a circuit, a lower circuit or upper circuit, I can lose a lot of money. So how do I manage this trade? Is so intraday I'll create this trade. Okay, if you look at the Greeks, you will see that theta is 829, which means if the market stays flat, you'll make 829 rupees per lot every day on this Strangle. So how do I manage the risk of this is, so basically my core trading style is I sell options in both direction, okay? And once the options are sold, and how do I sell them is using, that is like bit more of an explanation would be needed for that, but simply I look at previous week high and low. So currently previous week high is around 35,000. So to be on a safer side, I'll sell 5 strikes or 10 strikes away from that. Current week low is 34,000, so I'll sell 33,000. So, and the premiums would be almost similar if my view is neutral. Okay, but the risk is undefined in this. So what I'll do is, this I'll create intraday. If the decay is happening, fine. If I'm carrying this position open, whatever premiums I've got, so currently I've got 240 plus 190, which is approximately 450. So 4 or 5 strikes away, I'll buy the put option. So basically I've sold 33. So I'll buy 32,500p. So currently you'll see that my max loss is undefined, right? I'll just buy this. You'll see that my loss is capped on the downside no matter wherever the market goes. Same thing I'll do on the upside also. So I've sold 36. So I'll buy 36,500 call. And now you see that a naked Strangle is converted into a Condor. So overnight I would suggest everyone to create a Condor or hedge your trades basically. Don't take a maximum undefined risk trade overnight. So in this, what will happen is, see the margin from 1.5 lakh has reduced to 46,000. Earlier the margin was quite higher for a naked trade. So you get the margin benefit also, plus your loss is defined, and you can see still if the bank nifty stays about 32,840 on expiry, you make this maximum profit, and 37,160 stays below that, you make the maximum profit. So intraday you start with a naked Strangle, overnight you convert to a Condor, and next day again you can create more such trades to benefit from time decay. So this is my overall course. So I try to manage my risk overnight. Intraday I take risk, but overnight everything is risk defined.
Sure. Do you convert that trade back to a Strangle the next day, or do you keep it as an Iron Condor?
So next day what I'll do is, intraday I'll exit the hedges, okay? And suppose the market opens with a gap down. So what will happen is this call will decay. So this call suppose from 190 comes to 120. So in that case, I'll roll down the calls to suppose 35,500 to match the premium of my put side. So in this, what will happen?
Got it.
So something like this. So again, if the market, in the morning I exit the hedges, and intraday I stay in Strangles. Overnight I again hedge and carry.
Sure. Yeah, it's amazing. Thank you. And we'll talk about, that tool as well that you're using. So before we talk about that, also one thing I wanted to talk about really quickly was you talked about how the markets are, usually 80% in a non-directional environment and 20% in directional. Just a kind of a quick way, how does someone kind of know if the markets are non-directional or directional? Like, is there any sort of a test or tool that you can use to define that?
Okay, so basically, currently if you see what has happened in April is the market is not giving any direction. So market is going up, it is again reversing, the market is breaking down, and such phases are basically very bad for trend followers and as well as option sellers, because the volatility is there in both directions. So what generally I do is, my core style is basically intraday. So for intraday, what I do is, so basically if the market today's open is within yesterday's range, which means if today's open, so I'll show that with an example also. So basically suppose bank nifty is 34,482. Suppose the low is, today's low is 34,000, high is 35,000. And tomorrow if we open with between 34 and 35, which means we have opened within yesterday's range. So generally whenever that happens, mostly the market is sideways for intraday. So those are the days when you can create a non-directional trade. But for intraday, what I look for is previous day high and previous day low. So suppose if previous day high is broken, I would maintain a directional bias, bullish bias intraday. If previous day low is broken, I'll maintain a bearish bias. But if you look at an overall structure, what I follow is, so basically I'll show you this filter which I extensively use.
Sure.
So what this shows is, so basically I use the moving average to define the trend. So a stock or any instrument which is greater than 20 moving average in the daily time frame as well as in the hourly time frame, the trend is bullish for that stock. So this is just to filter out stocks. So if you see current market on the Nifty, there's only one stock, which shows that the market breadth is quite negative. So basically this screener I run on the Bank Nifty or anything to at least identify what is the overall trend, and intraday I look for previous day high, previous day low for low risk entries. So if the previous day high is broken, I'll take a low risk long trade. If previous day low is broken, I'll take basically a trade in which my bias is on the downside. Yes, but I have done extensive back testing. But the main problem is when the market goes from directional to non-directional. So those are the most difficult phases for traders, and there's no quantitative method to actually identify that, okay, now the market is going to be non-directional, or now the market is going to be directional. So if you see in the current market, markets are at the same level, okay, since 1 or 2 months. But the volatility in between is so high that on a longer picture, it looks that, okay, the market has not moved at all. But in a shorter time frame, if you're trading actively, you see a 1,000 point swing every day.
Right.
So so I think quantitative methods, basically for me, that's why I focus on intraday. So previous day low are crucial levels, and that have been working well for me.
Sure. Also, one thing I wanted to also talk about was, on your Twitter, you talk a lot about debit spreads, right? Just wanted to know, can you define a debit spread for us? How does it work? Why do they work? And how does one execute a debit spread?
So whatever we discuss here, this is basically a credit strategy. So what are credit strategies in which you basically have time decay in your favor? So if you see here, Bank Nifty is 34,482. Even if Bank Nifty stays within this range, you make money because you are benefiting from time value. You can see here, Greeks is the time decay is theta is positive, which means the strategy in which time is in your favor is basically a credit strategy. So opposite of that, debit strategy. So debit strategies should be used when you are expecting a big move on either side. If you're expecting a move on the upside, you will create a call spread. If you're expecting a move on the downside, you will create a bear put spread. So I'll just show an example. Suppose Bank Nifty is at 34,500. You think that markets have already fallen a lot, okay? And the premiums are too low to sell. So what you can do is you can buy an ATM call option. So basically the current price is 34,500. So I'll buy this call. Okay, let us do this in the currently. So I'm buying this call. Once I buy this call, whatever premiums I've collected. So I've collected 200 rupees. So I'll sell 2 strikes away. Options. So this will essentially convert my trade into a debit spread.
Okay.
But if you see here, the break even is 34,582, which means if the market goes up 100 points also on expiry, I don't make any money. Why? Because the time is not in my favor. You will see that theta is negative here. So basically, in a debit spread, you should create a debit spread when you're expecting a big move. Okay, and when you think that the premiums are low or the volatility is going to spike. So in that way, what will happen in the market? The volatility spikes, that will benefit long options. And basically, if your view goes right, you see the risk is 2,000, okay, but the profit is 3,000. But in case of credit spread, it will generally be opposite. So you will make 5,000, but you lose 10,000 if the view goes wrong. But the probability is in your favor. So both have its pros and cons, but debit spreads should be used only when you're expecting a move, and that too also quickly. Like suppose you're expecting a move in 1 or 2 days. And one more thing in debit spread is, suppose I have sold 34,700. If you are very bullish, then the more far strike you sell, the more profit you will make. Suppose I am selling 35. So you will see max loss is 8,000, but the max profit is 8,000. 4,000 max loss, but profit is 8,000 if the view goes right. But again, the probability is low. So I generally prefer credit strategies than debit strategies because the probability of profit is always in your favor.
Got it. And everything seems to be a function of having some sort of a view, right? And based on what you expect to happen, then you can execute one of these strategies, right? So, something else I also wanted to discuss based on, again, your Twitter, where you talk about a lot of these things. And of course, we will include a link to that in the description of the episode, is you talk about trading on expiry day, right? And obviously, for a lot of our listeners out there, I'm not sure if I would recommend trading on expiry day. Maybe you can expand upon that. But trading on expiry day can be a thrill, right? And a lot of things can go very bad and they can also go very good. Just generally speaking, if someone wants to trade Nifty, BankNifty derivatives on expiry days, what are some things that, they should be thinking about?
Okay, so as we started that options decay with time. So if you talk about a life cycle of a weekly options, so suppose Thursday is the expiry. So the next week option starts from Friday. So the most decay happens as we approach Thursday. So on Thursday, the options which are OTM have to become zero. But so basically, if you're selling options on expiry day and if the market stays within the range, you'll make a lot of money. But the risk is on expiry day, the gamma risk is too high. So even in a small move, you can lose a lot of money. So so in 2019, when the corporate tax rate happened, after that the next expiry, what happened is there was a sudden spike in the market. A 50 rupees option went till 1000 rupees, and eventually it became zero. So you could only make 50 rupees as profit. But suppose your stop loss got hit at 1000, or you did not keep any stop loss and you exit at 1000. So you lose 950. So the risk to reward was not favorable. So if you're trading expiry, the risk management has to be prudent. So of all days combined, the maximum risk is on Thursday, on the expiry day, and the maximum reward is also on Thursday. So my plan of action or my suggestion for traders who are beginners would be to create risk-defined condors on expiry day, because you know your max loss. So even in the market volatility, market goes up, goes down, you know your max loss and you can stay in the trade till the end. So to just give an example, suppose current week we are at 34,700. Suppose you sell a 30,000 call in the current week and you sell a 34,000 put in the current week. So today is Tuesday. By Thursday, Bank Nifty stays within this range. Both of these options will become zero. So which means on the deployed margin, you will make 3% in 2 days. But the risk is unlimited. So on the expiry day, I would suggest you buy the hedges at the same time. So whatever your break even is, so on the downside, the break even is 33,800. So you buy 33,800, put on the downside. On the upside, your break even is 35,200. So you buy 35,200 also. And you will see that if the market stays within this range, you'll make money, and you know your loss is also defined. So there's no undefined loss. So even if you do this, all 52 expiries in a year, even if you're right, like half of the time, still you make money, because on the days you are wrong, you can easily do some adjustment. So suppose the market is going down. I'll just do one thing. I'll create one more spread on the upside. And you see that my loss on the downside is reduced.
So this trade that you made right now, this hedge, was this the Iron Condor execution?
Yes. So
got it. Okay.
I would suggest that the traders who are new to the market would directly start from this, because you already know your max loss on both sides. And if the market stays in this range, you are able to make money. So you don't have to, and the profit, like the probability of profit is quite high if the market stays in the range, because on Thursday, the options have to become zero. So I would say that do this, because if you see there's a margin benefit also. So if you see you're hedging your trade, your margin is 40,000. If I just remove the hedges, you will see that from 40,000, the margin will shoot up.
Mm-hmm.
So you can see from 40,000, the margin has shot up to 1.5 lakhs.
Mm-hmm.
So if you can hedge and do triple of the quantity, then also still you are in a risk-defined trade.
Sure.
So my suggestion for traders who are trading, especially on expiry or like who haven't explored expiry, to start small. It's lucrative, but the risk is high. Okay, there are days when 50 rupees option or even 1 rupees option have become 100 rupees intraday on the expiry day and eventually closed at zero. So if you don't manage risk on the expiry day, it can be very risky. So suggestion would be start the hedge trade on expiry day and let the market, if the market is in that range, you will be able to make money.
Sure. Yeah, and everything obviously always comes down to risk management, right? That's the most important thing. Another Twitter post of yours is where you discussed, this is actually a recent post where you discussed, you were up 5% on capital during a particular week. And then, you ended up down 1% at the end of the week due to some mistakes that you made. Could you walk me through that week and, what were the mistakes that you made and what did you realize from that whole experience?
Definitely. So I've written a detailed post also on that. So see, one thing that is common to all traders is on a winning streak, we actually get complacent. We don't respect risk too much. So since December to March end or mid-April, I was up almost 25% on my capital. So I had a profit cushion and so I was taking more risk on my trade. So when I'm on a winning streak, I'm generally taking more risk. So what happened is, on Tuesday, this is the chart. Bank Nifty fell 1200 points in last 30 minutes on Tuesday. So I did not manage my risk properly on that day, and the option which I sold at 50 rupees, I exited at 350. Generally, I take a stop quite early, but on that day, because I had a profit cushion of last entire week, I was like, let me increase my risk appetite. So on this day, my stop loss got hit, and this day only I lost around 1.5% of my capital. Next day, what happened is, this many people don't know. So if you see, this move happened in the last 30 minutes. So in Indian markets, we follow weighted average closing. So what happened is after this price action, I carried a bearish trade overnight, but the weighted average closing was 300 points higher. So in India, from 3 to 330, whatever the move happens, the closing will be based on the average of the last 30 minutes. So basically, I had sold naked calls, and the call which I had sold at 82, the closing was 286. So this meant another 1% loss due to carrying. So this happened, and again next day, like the entire week, there was extreme volatility and the stop loss were getting hit in both directions. So due to that, like next day I carried a bullish position. Market again opened with a gap down. So you can see that I carried a bullish position and the market opened with a gap down. This again resulted in a 2% loss. So after this, I became more prudent. I was like, okay, now my profit cushion is going away. So after that, I reduced my position size and was playing defensive. So when I'm on a winning streak, I'm very aggressive. But when I'm on a losing streak, I basically cut down my size and I'm not quite aggressive. So the mistakes I would see is basically first was Tuesday. I got too complacent and took a bigger stop. Okay. And just because of that loss, I generally avoid carrying overnight, but I carried overnight. But the weighted average was 300 points against me. Then again, the next day I carried a bullish trade, market opened with a gap down. So all 3 days I did mistake. But if you go on Twitter, this is a phase where most of the system traders are facing a drawdown. So I wrote a detailed post on that also that, see, I have faced almost a drawdown of 5 to 7% at least twice a year, almost every year. Because there are phases when that whatever you do doesn't work. But I would say that such phases like improve you as a trader. As they say that a smooth sea never made a skilled sailor. So if you don't go through drawdowns, you won't understand or you won't be comfortable trading all markets. So after that, I've reduced my size and I tried to contemplate what did I do? Was it my fault? So I realized yes, it was my fault because I did not manage my risk properly when the markets went against me. Then I try to think, have the market conditions changed? So I believe that the market conditions are more or less similar, but yes, the volatility has increased. And whenever I faced such drawdowns in the past, I've actually written how I was actually feeling. Because see, no matter how good of a trader you are, if you don't make money for a prolonged period of time, you start doubting yourself. Am I doing the right things or what am I doing? So I try to learn from that, what could I have done better? But yes, basically this is something which is a part of the game. If we are trading, we have actually signed up for this. There's no strategy which will give you money all the time. The only thing is make a mistake so small that it can live to make another. Don't make such a big mistake that you don't have the capital to make another new mistake.
Sure. So a couple questions come from that, and we are going to talk about drawdowns as well. You mentioned that when you are on a winning streak, you tend to increase your risk, right? Generally, is that a good principle for a trader? Like when things are going really well, should they actually think about potentially increasing the risk per trade and things like that?
Yes, because what I believe is, so if you break down the entire year into 12 months, there are 6 to 7 months where I make a very good amount of money, and 2 to 3 months are break even, and 2 to 3 months I'm losing money. So if I want to have that extra cushion, so I need to have a cushion of profits also when the markets are in my favor. So, and when a trader is making money, suppose you make money today, okay, you make money 3 days in a row, automatically your confidence increases, and even if you lose the next day, you are just losing your profits, right? So what I do is, suppose I make X amount of money today. So tomorrow, I'll take that additional risk tomorrow. So my daily loss limit is 1%. But suppose I have today made 1%. So next day, I have that extra cushion of taking extra risk if the market is in my favor. So what this does is, when the markets are in my favor, so for example, as I said, December, Jan, Feb, March and mid-April were in my favor and I was taking risk and the risk paid off. So when in April actually I hit, like there was a drawdown, still I am net green because the days like earlier I had taken additional risk and generated additional return. So even in the bad phase, that gives me a cushion. So what I see is most traders do is they have a target for a month. Okay, I made 3%. That's it. I close the system. But see, when you lose also 3% or probably more. So if you don't have that profit cushion, suppose you don't have a profit cushion of earlier months. So even if on a drawdown streak, you'll feel discomfort because whatever you made, you're actually giving it back.
Sure.
So
yeah.
I believe that as a trader, there are few phases when the market gives you money in spurts, and we need to take the advantage of that, especially
take advantage of it. Yeah. Right.
Yes.
Sure. I really like that analogy. And also, something else you mentioned, or actually one of your habits, I would say, is to actually, the fact that you're writing out a Twitter post, I think is very powerful because, this is something I'm guessing a lot of people don't do. They don't reflect upon, these situations, right? But you're obviously doing that. And what is the benefit of that whole activity, right? Because this is probably something that our listeners can listen to, like when we go through a drawdown or when we go through a series of steps which leads to a decision, which then we feel like, oh, maybe I should not have done that or should not have done that. You actually take the time to reflect upon the whole situation. How should a trader go about reflecting upon their trades to ensure that they don't repeat those mistakes?
Okay, so the main reason for writing those out in the public, and if you see my Twitter post, I never post a profit screenshot. I'll always post a loss screenshot, because if you see most of the screenshots, like people say that I've made this much amount of money, and which is very frequent on Twitter, but that generally doesn't help. Okay, I'm seeing, okay, this guy made 10 lakhs, but how does it help me? I did not learn anything. Okay. But if you put something about your loss, there are people who have actually had that bad day and they relate to it and they get confidence from that. Though someone who's starting new, okay, like this, I was not alone. So what happens is, suppose in my office there are a lot of traders. If I alone lose, I feel bad. If everyone's losing, okay, I did not do that bad. So Psychologically, I would say that putting out the mistakes in public helps me also, because I also make sure that I have a responsibility towards my participants and all that. Okay, I also need to, because I would say that no matter whatever system we follow, but there are some times when you actually you shouldn't do that. You realize, okay, for example, in mid-April, I actually took additional risk, but but after looking in hindsight, it feels that okay, that was a bad decision, that I took so much additional risk. But now I've put it in the public, I've noted in my diary. Next time I'm sure that whenever that happens, I'll be complacent, that I won't get complacent, and I'll basically manage my risk. So the only reason for posting that out in the public is that people basically on social media, it's shown that trading is okay, it's a holy grail, you can make money every day. It is not a true picture. And as a trader, no matter at whatever scale you are, there are phases when you doubt yourself. There are phases when your system is not making money. And only if you believe in your systems, eventually you will make money. So drawdown is a part of the game. And for that reason, I always post out in the public whenever I'm in a drawdown.
No, and it's really funny, right? Because for those who are not trading or who have no idea about how the stock markets work, you would think that if they just went to Twitter, that they would think that trading is like this amazing thing where everyone makes money, you know, and you know, obviously that's where, you know, the fact that you share your losses as well, I think it just shows that you're vulnerable and you're willing to kind of put yourself out there, which is actually how life is, right? So I think that's people can, you know, something that people can relate to. To kind of follow up on the whole drawdown topic, you mentioned that you go through this 5% drawdown, right? At least once or twice a year. How do you kind of make sure that your risk is controlled? And also maybe more importantly, how do you kind of deal with that psychologically when you're going through it?
Okay, so when I'm in a drawdown, so what I do is overnight I try to reduce my risk, because basically intraday I'm able to control my risk, but overnight the risk is not in my control. Even if I hedge it completely, still there's a max loss possibility if the market opens either direction. So when I'm in a drawdown, I basically try to trade mostly intraday. I avoid trades overnight. And my major focus, as I said, my major style of trading is basically trying to capture time decay. My major focus is on the expiry day, because expiry day, if done properly, is quite lucrative because the premiums eventually have to become zero. So I would say when I'm in a drawdown, I avoid overnight risk. I look at my past mistakes, what I had done, how did I feel during that drawdown. And so major trade risk is managed intraday, and in a drawdown, I'm basically like not taking any additional risk. So suppose I've already lost, suppose a 5% of my capital. So the next trade I'll do is will be with a slightly reduced size. So 1% of my current capital. So even if the trade goes wrong, if I'm on a losing streak, my next trade will always lose less money than the previous one. And the confidence is basically by trading through so many years, you actually know that, okay, this too shall pass. So like, okay, when there's a bad time, okay, next good phase will also come.
Sure. And that's something I really appreciate about your Twitter, because again, you're not just talking about days when things don't go well, but you're also talking about the takeaways from that situation, and how you can learn from it, which leads me to my next question. You know, one post of yours, which I really liked, and I see a lot of analogies with sports, right? And generally in trading, right? You know, you talked about how this too shall pass. I think athletes actually have to go through these things all the time, right? They have to ask themselves, have I been in this situation before? And kind of psychologically be on top of the game. But you talk about, you know, Sachin Tendulkar and how, you know, we can learn about trading discipline by emulating his approach to cricket. And I really like that post, you know, because I love these analogies to sports. I was wondering if you can elaborate on that. You know, can you kind of elaborate on that whole analogy?
Sure. So basically, if you remember Sachin's inning against Australia, so in that series, Sachin was struggling by playing on the offside. So all his dismissals were on the offside. So what Sachin decided is he won't play any shot on the front foot, all like on the offside, and all his shots will be on the leg side. So I'll just show you the wagon wheel for that.
Sure.
Yeah, as I said, like I'll show you the wagon wheel of that.
And I have to admit, I'm not a big cricket guy. So, which was really ironic because I was in India for 10 years and everybody would watch these cricket matches and I wouldn't really know what's going on, but that's fine. You know, we can still take the principles out of this whole thing.
Yes. So if you see this, all his shots, majority were on the leg side. And Sachin is basically known for his cover drive. Okay. And no one plays better than him, the cover drive. In fact, Harsha Bhogle said that when Sachin plays a cover drive, the world is more beautiful. So basically you can see that this is what we can learn from him. He imposed a barrier on himself that he won't play on the offside because he was losing wickets by playing on the offside. So this is what discipline is, like a player like Sachin who can like smash on the offside if he wants to, but still put a barrier on himself that just because he's losing wickets by playing that shot, he'll only play on the leg side, and whatever balls were placed on the offside, he was leaving that. So the trader, when we are in a drawdown or when we are in a difficult phase, we need to follow a system and have that discipline. Okay, so basically waiting for a trade. Okay, the trade is not in my favor. I'll wait till the time I'm not getting basically trades which are very convenient or very favorable for me. So Sachin was playing only shots which were on the leg side because it was very easy for him to hit on the leg side. All the shots, all the balls which were pitched on the offside, he actually left that ball and did not play that shot in spite of him being very good at it. So I would say what main we can learn from is discipline. So basically they say that leaders are not what they basically do, but what they can stop themselves from doing. So in spite of knowing that he can play any shot on the offside, he stopped himself from doing because that was not giving him the performance. So he did what was needed and actually scored 241 in that inning. So I think this is something, and I'm a big Sachin fan, and this is something which I always try to think upon, that if things are not working in my favor, let me not do things which I was doing. So like if Sachin was playing on the off, he was losing wickets. So I'll also try to do things which are not working for me and only focus on things which are actually working.
Sure. Yeah, I really like that analogy a lot. So let's kind of switch gears a little bit. Let's kind of talk about the different tools that a trader should use. So you actually in this conversation opened up a couple of websites. If you can kind of walk us through, those websites, and also generally, Sourabh, on a given day, what are the types of tools that you're using, as a trader?
So as I'm primarily trading option premiums, so the major site which I use is iCharts. So basically what this does is it will give me a combined plot of the Strangle or straddle I am selling. So for example, if I'm selling this straddle 34,500, so this is basically the combined plot of that straddle. So for me, this line or whatever the straddle is has to go down because I'm a seller of this straddle. So basically this helps me visually see that, okay, whatever I'm selling, so basically I'm not looking at the Bank Nifty spot chart, but I'm looking at this straddle chart or the premium chart, so that if this is going down, the trade is in my favor. If this is spiking, I'm losing money. So basically this is a tool which I extensively use to basically track the premiums. Other than this, there's a site called Quantitative which I use. So basically to analyze stocks which are moving intraday. So there are a lot of things in this. So basically to identify stocks where the long build up is happening. So you can see here basically built up. So basically if I go to build up, you'll be able to see stocks where there's long built up, stocks where there's short built up. Then you can see what is happening on the option chain side. So basically where is the maximum put OI, where is the maximum call OI. So these are two sites which I majorly use, and I would say any one of them, retail traders, if they're trading options. So if you're trading options, any one of these you can use. They are not expensive also. But if you're trading options extensively, I would say this is what I majorly use, iCharts, because it helps. It has all the features also. So if you go to home here, you can see stocks which are moving up, stocks which are price losers, right? So you get an overall idea about the market and whatever features are needed basically in the option chain or in the option chart, basically volatility charts, everything is there here. And other than this, there's one more software which I use, which is slightly expensive, called Spider. It basically tracks tick by tick data. So if there are very big buying orders in any instrument, it gives an alert. But I would say for a retail trader, that would be a bit expensive. But this is something, if you're trading options, you should definitely have in your tool.
Sure. And of course, we're going to include all that information in the description of the episode. Finally, let's talk about, Quantify Capital, and specifically, you have something called the Quantitative Trading Program. I believe it's an annual thing. Can you tell us a little bit about it, and how does a listener actually register for the next batch?
So basically, so I'll give you my background. So like few years ago, I took a session at IIT Bombay on quantitative trading. So I got a good response from that. And after that, I did at IIT Delhi, few IIMs. And then what happened is a prop desk approached me saying that I want you to train my traders. So I was like, I actually don't know how to do this because I've always done it at academic level. He was like, no, you do it. So I was like, okay, let me try. So after that, I got a very good response, and then COVID happened. So this entire thing, earlier our focus was only prop desk. Then we shifted this thing to online. So basically, a quantitative trading program is a course in which we cover Python basics. We teach how to backtest, how to automate, and we also discuss trading strategies. And we have done this at some of the largest trading houses of the country. And if you see, everything is mentioned here. So it's a quite detailed course. It's a 5-month course, and
wow.
Everyone has an assigned mentor. So I would say, and this you can see I've done at top institutes, top trading houses. So this is for people who actually want to put in the time to learn how to code, how to backtest, how to automate their ideas. And so basically this gives you an extra edge because everything is data driven now. So you're actually able to automate your ideas and being able to think in a data driven manner. So I'll just give you an example for that is, so if you see here, so this is like how it looks like. So basically whatever data here. So this I did for a company called Futures First. So I had a lot of data. So I wrote the code for that. So the data is plotted. So then you can see, you get a lot of insight. Okay, how the data is distributed. So this is basically, if you see here, how the months are, basically how much volume, and also visually you can see. Then you can see basically one thing, which basically this we did, there's no S&P. So the probability of price going higher than 4% from open is only 0.4% in case of S&P. So even if you have this small information, if you're building a trend following system, S&P is already at 4%, you know that the chances of it going higher from here is quite less. So you can use this information to build your trading strategies. Then how the volume is on days, heat map, basically month and year wise, what are the returns. So it visually gives you an effect if there's any seasonality. And so there's so much. So basically this is just the data analysis part. You can backtest, automate, and a lot of stuff can be done.
Sure. No, we're going to include all that information as well. And what I really like about Quantify Capital is you guys actually walk the walk. You're not just talking the talk, you know. So, you know, Sourabh, this is a really nice conversation I had with you. I know we've spoken before, but I really learned a lot today, and I'm sure listeners are going to learn a lot. Again, I recommend everyone to follow Sourabh on Twitter because, again, he's not just walking the walk, but he's actually being practical about his day-to-day life as a trader. He's not just posting, you know, the MTM screenshots of profitable days. In fact, he does the opposite. And so, you know, thank you so much for today's conversation, Sourabh. Last question I have for you is, this is obviously what I ask every guest. Where do you see yourself and Quantify Capital in the next 5-10 years?
So my major focus, I have basically two focus. The first is basically setting up the own prop desk. So basically expanding the trading. So currently we are trading a decent size. The goal is to expand that further in the next 5 years, build a team of traders. So basically you're diversifying, basically someone who's good at trend following, someone who's good at option selling, someone who's good at option buying. So basically building a team, expanding and like growing your AUM in the prop trading. And second, my major focus is basically to grow the ecosystem. We need to teach people. So I'm actually building, that's why you can see this green screen behind me. I actually shoot here. So basically building basic content about the markets and practical stuff like, okay, not theory. Okay, how this is done in the market with real life example, real trades. So that you actually understand, because in options, what happens is there are a lot of things which they actually teach you theory. But when you come to the markets, you have to like, you don't understand. Okay, like, so if I show you a debit spread, bull call spread, you'll see, okay, this is the amount of money I can make. But in real time market, that profit will come only at expiry. Like rest you lose money. So how that happens in real time, basically building a lot of content around options, around technical analysis, around fundamentals, and to grow that and like basically grow the entire ecosystem of financial markets.
Sure. And I love that. And you know, again, I get all sorts of different answers to this question. Some people will say, you know, they want their business to be at a very specific point, or others will say they want to be managing a certain amount of money. So I'm very curious to see how people respond to that question. But you know, obviously what you're doing is working really well. So thanks a lot for today's conversation.
Thank you for having me. I really had a great time and I love the conversation.
Cheers.